Pleasure to welcome you to the second of our Beyond Capital series, The Future of Money in 2020. It's my distinct pleasure to welcome Amy Dyck and Shambhavi Sole to this webinar. The team spent months reacting to the COVID news and leveraging our database, which now consists of almost 20,000 companies and well over 1,000 fintech companies, to give you this research. So without further ado, I'll turn it over to Amy.
Thanks, Peter, and good morning and welcome everyone. As Peter said, I'm Amy. I'm one of the associates on Framework's team. Now, in terms of the agenda today, let me just flip over slides. We're going to run through a brief introduction and then introduce our thesis, and following that, we'll share a quick view on what we see that's happening in the private markets right now. And then Peter and I will also go through our 7 predictions. And at that point, I'll also introduce Shambhavi to cover a topic as well. And it's worth mentioning that our white paper on the topic is currently live on our website if you want to click there and to find more. Now, as Peter mentioned, some of you might have joined us a few months ago when we gave the first of our Beyond Capital white paper and webinar series. And in that one, we talked about the changes in the retail landscape and some of the impacts that COVID-19 has had on that sector. And now, as we've continued through this pandemic, we've also continued to evaluate what other sectors or areas are facing the similar tectonic shifts that we're seeing and that we saw at the time in retail. And there's been a lot of change in the last few months. The world has in fact changed, and where do we go from here? I mean, that's been the question for a while. And now we believe that financial services are one of the sectors that's facing massive changes with a move to increase digitization. And we believe strongly that the current environment is creating deep-seated changes in behavior that will ultimately result in profound, meaningful, and long-term changes in financial services. So this brings us to our overarching thesis, and you can see it on the slide, that every single financial service that a business, individual, and entity can employ will be conducted digitally by the end of 2021. And as Peter mentioned, this thesis is founded on observations that we've made from the thousands of fintech companies that we follow in North America. And we think that due to COVID-19, that this timeline has actually been truncated by as much as 5 to 7 years. And even as we hopefully soon will have a vaccine and the world begins to reopen, we think that this complete digital delivery that used to be thought of as more of a pipe dream is now a very forced reality within the space. And this will be accompanied by trends that will persist in the long term. And this has huge ramifications across all aspects of the industry, whether it's in infrastructure, cloud, data sets, AI, or ML. The world has profoundly and very deeply changed. Now, since the financial crisis, Bloomberg reports that Canadian banks have spent more than $100 billion on technology, hoping that consumers would embrace the digitization of financial services. And in a few short but very turbulent months, it would definitely seem as though many of these investments are paying off. The ability for banks to offer digital banking across the realm of financial services really quickly moved from a nice to have to a need to have. And globally, we've seen this through a 30% increase in overall mobile banking. And we don't think that this is just a short-term bump. Beyond this, we think that once consumers realize the benefits and conveniences of these services, that this will lead to higher levels of adoption across the board and into the future. Now, on the private side, global fintech investment has reached $25.6 billion through the first half of 2020 that you can see on the left. And this number includes VC, PE, and M&A transactions. Now, compared to 2019, obviously overall investment activity is lower in the first half of 2020. And it also looks worse to 2019 due to a lack of mega deals. And it's worth mentioning that last year's numbers included the acquisition of WorldPay by FIS for $42.5 billion. And overall M&A has fallen off during the first half of 2020 since most deals really slowed or came to a complete halt. But while M&A has slowed, payments and lending remain the most strategic areas of investment. Now, whereas on the venture side, on the right, VC investment remains strong and is trending to be on pace with 2019, at least through the first half of the year. And the payment space has been the hottest in terms of investment dollars. And we've seen more of a focus on later stage fintech companies, which is consistent across the VC space, at least through Q2. Now at Framework, as Peter mentioned, and some of you might be familiar, we manage and track our own proprietary database of almost 20,000 startups across North America. And in 2020, we've added over 1,000 new fintech startups alone. And we wanted to highlight just some interesting stats from our database. So most of these companies are focused on data, and most were founded 2 to 5 years ago. And these companies are growing at pretty impressive rates. We see year-over-year growth rates of 200% at the seed level, 260% at the Series A level, and 125% at the Series B level. Okay, so let's dig in a little bit further. So as we believe the timelines for full digitization have been shrunk by 5 to 7 years, what we've done is we've outlined 7 predictions within the different areas of financial services that we see occurring throughout the next couple of years. And there's lots to unpack here. We go into much further detail in the white paper, but for sake of the webinar, we'll run through all of these at a little bit of a higher level. So the first prediction is on payments. And we think that cashless and contactless is the future, and we'll no longer need cash. Second is on lending. We think the entire credit cycle will change the way it assesses risk, instead relying on dynamic and real-time data points. Third is on insurance. We think connected devices and the increased use of data will enable real-time usage-based or UBI rates. Fourth is on infrastructure. We think the implementation of cloud as a business strategy will finally enable large incumbents to truly embrace digital. 5 is capital markets. We think capital markets are changing. Traditional methods of price discovery are no longer relevant, while retail trading will forever be digitized. 6 is on money movement, and we think how we move money will fundamentally change. P2P or peer-to-peer transactions will lead the way to increase the overall adoption of all digital transfers. And lastly, on retail banking, we think the retail bank is moving online and will be fully digitized, and fewer bank branches will be needed, if at all. Now, our first prediction is on payments, and we think that cashless and contactless is the future and will no longer need cash. I'm going to let Peter come back in and run through this in a bit more detail.
Thank you, Amy. So one of the big theses we've had for a while is that the world was going to move more to a cashless society. But cashless doesn't mean that money isn't moving. Cashless doesn't mean that we aren't tapping some sort of existing rails or upgrading the rails that are in use today. What we're talking about is the removal and need of reaching into your wallet and using paper cash, and instead storing your information in a very convenient and noticeably always present way on your smartphone. So we're seeing now with Interact a record number of e-transfers that took place in a single month, 61.3 million, up 62% year over year. This is breathtaking growth. And interestingly enough, this sort of peer-to-peer payment mechanism we think will continue to pervade and grow even more. 46% of respondents swapped out of their top-of-wallet card for one that offers contactless payments. Contactless payments are the must-have in a COVID environment. But importantly, this behavior will become learned and embedded, and we believe will be the future of ways in which we will conduct our business in physical retail. Importantly, 52% of those under 35 years old believe in contactless payment. 62% of Canadians report that they're using less cash, and 53% reported using more card or mobile tap payments. These are breathtaking numbers, and numbers that we did not expect to see for a number of years in Canada. Canada was one of those markets where we felt like a lot of the behaviors were entrenched. COVID flipped that upside down, and now those learned behaviors are becoming pervasive, ingrained, and importantly, required for the current health crisis we're experiencing. So, where do we go from here? It's interesting to note that the QR code has existed for decades, but it took a pandemic to make the QR code something of a bit of a mainstay in the payments world. QR codes allow people to exchange and nominate tokens that can permit the exchange of funds across rails. The other types of transactional capabilities that we're seeing exist are audio tokens or audio codes. All of these codes enable a way that a token, a very secure token, can be handed off to devices, authenticated in the networks, and then money can move. This kind of pervasive ability to exchange cash, to create payments, we think will remove the need for dedicated payment terminals over time.
Perfect. Thanks, Peter. So our second prediction is around lending. And we believe that the entire credit cycle will change the way it assesses risk, and it will do this through relying on new data points that are dynamic and real-time in nature. Okay, so that was a mouthful. So what do we mean by this? Well, to take a step back, obviously, credit scores are an important part of assessing risk. And these are important as traditional FICO scores are used in over 90% of lending decisions. And currently for consumers, it's hard to predict how soon your credit score will change, but on average, this process takes around 45 days. Some businesses send credit report updates daily, while others are monthly, but for the most part, it can take several weeks for a change to appear on a credit report. And as you can see on these charts, payment history and amounts owed are the two most important factors in determining a FICO score. Now, at a consumer level, the speed in which COVID-19 has brought economic damage is pretty staggering. And above, we show the US and Canadian unemployment numbers. And as you can see, while these numbers have improved, as of September, there were still 12.6 million Americans and 1.6 million Canadians, unfortunately, out of work. And these numbers are the worst economic performance indicators in over 100 years. And so what this means is that the creditworthiness of many has changed within a very short period of time. But what's really interesting is that you can see average credit scores have actually gone up. And this is an article from the Wall Street Journal that they published recently on this very topic. And they found that even though COVID-19 has essentially pummeled the US economy, Americans' credit scores have gone up. The average FICO score reached 711 in July, which was up from 708 in April and 706 a year ago. And the reason behind this is largely due to the stimulus provided from the US government, which has helped consumers keep up with bill payments and in some cases pay down debt. And obviously this is a good thing. But what it means is that it's continuously harder for lenders to accurately assess risk. It's likely that most lenders did not anticipate this back when the pandemic first hit in April or May. And it's now almost a strange situation of millions of Americans out of work and surviving on unemployment benefits, yet credit scores are still strong. It's also our guess that the rapid fluctuations in temporary furloughs and massive rehiring that we've seen in the last few months has yet to be properly reflected. And these scores are typically lagging variables. In the last recession, credit scores bottomed out at 686 in October 2009, which was actually months after the recession officially ended. And so the gist of the problem is that static credit reports might not be reflecting what's truly happening in a really timely or real-time manner. And the solution to this, in our view, is to look at alternative data sources that leverage thousands of dynamic variables. And we're seeing more and more lenders looking for new ways to help evaluate creditworthiness. One example could be looking at cash flow analytics. So if they see a lag, it could mean a potential layoff, or using other bank account data from the FI itself, if you have all the appropriate permissions. And it was the view of the power behind this data across the credit cycle and the massive opportunity behind it that led to our recent Series A investment in Anomaly. Now, Anomaly uses de-identified data on consumer behavior to help collection agencies determine the most effective outreach tactics. And this works through the phases of servicing, delinquency, and the recovery life cycle. So how this works is that it ingests historical data to analyze debtor accounts, and then the Anomaly machine learning platform can either filter and then prioritize these accounts. And these proprietary ML models are used to individually score each account across dozens of dimensions. Some of the models include the propensity to pay or the likelihood of payment, time of day, which recommends the best time to call, omni-channel, which ranks communication channels, or settlement optimization, which calculates the best offer to help settle an account, among many others. And these models are incredibly powerful and we think more relevant than a static credit score. Now, we don't think the credit scores are going anywhere anytime soon. However, as economic conditions continue to change and evolve and cloud technology and AI continues to improve, we do think that the departure from static scoring is inevitable. And due to the simple growth of consumer data, this industry was due for a revolution, or at least we would argue so, even prior to the economic destruction from COVID. In fact, as consumer debt loads have risen over the past few years, some FIs have even developed their own innovative models to help with consumer segmentation. This is to find other contact methods to mitigate the loss from default. McKinsey has an example of one European bank that uses 800 variables, including demographics, overdraft info, transactions, and much more, to segment customers and then recommend collection strategies, including measures, restructures, and workarounds. And this has led to a 30% cost savings, which is pretty significant. Now, before we move to our third prediction, obviously any discussion on using AI or machine learning to assess creditworthiness should include a discussion on fair lending using this type of data, or at least we think it should. So if a lender is using a machine to analyze patterns and assess the likelihood of default based on data points like credit scores, bank account records, social media, or public records, there's a chance it could correlate this with a factor like age, gender, or race when making a decision. And obviously this is not a good outcome. But on the other hand, there are some studies that have shown that traditional FICO scores are already highly correlated with race and have proven to have a as you can see, a disparate impact on people and communities of color. And that's just one particular study we pulled that from. And if this is true, then that would imply that the financial system has already had centuries of bias. Regardless, the speed at which AI is evolving will likely lead to a need to address this sooner than later. And we just think that it's important that as AI and these models continue to advance, the lender can always ensure that they can explain the underlying rationale to make any type of lending decision. Now, our third prediction is surrounding insurance. And we believe that connected devices and the increased use of data, including what's changed from COVID, will lead to many new use cases, but also enable real-time or usage-based rates. And now I'm going to introduce one of our junior analysts, Shambhavi, to take us through this topic a bit further.
Thanks, Amy. It's been a pleasure working on this, and I'm happy to present our predictions on insurance. As we all know, data works well and guides decision-making until there's an anomaly. COVID-19 is perhaps the largest anomaly many of us will see in our lifetimes, and it affects all data sets because it's affecting everyone in all aspects of our lives, versus an isolated event like a wildfire or a flood. We thought it was interesting to highlight how this anomaly will have affected 3 different types of insurance: property and casualty, liability, and life. For P&C insurance, the impact of COVID has been mixed. The private auto business traditionally ranks as the largest P&C segment, but as our cars stay parked in our driveways, immediately one of the biggest data points affecting our car insurance rates, how many kilometers we drive, is dropping. This means that the probability of getting in a crash or any damage occurring to your car also drops, resulting in a lower premium. Virtually all private auto carriers responded to a dramatic decline in claims frequency in late March and early April by extending premium credits, discounts, and dividends. In the liability sector, travel insurance covered medical losses for those on affected cruise trips or sudden trip cancellations. Event cancellation insurance covered losses from large events. In fact, the CFO of Swiss Re highlighted a $250 million exposure for the 2020 Olympic Games. Commercial insurance claims are also expected to rise, mostly due to business interruptions. For business owners and landlords, they now have to consider the liability if a consumer or an employee were to contract coronavirus on the premises. In other cases, claims for slips and falls incidents have declined since more people are staying at home. Life and health insurers are facing multiple impacts across their value chains, especially including the long-term effects of coronavirus and how it affects terminally ill or individuals falling in the high-risk category. The coronavirus question has now been added to all life insurance forms and isn't going anywhere anytime soon. Switching to usage-based insurance, UBI has been most popular in the auto insurance market through the use of telematics as it adjusts based on odometer reading, mileage, or driver behavior. It gives drivers a say in how their premiums are calculated, partly based on how they drive. Capgemini has found that consumer demand for usage-based insurance grew from 35% in 2019 to 51% in 2020. They found half of all consumers want this now. During this pandemic, as many cars have been sitting in garages, this demand has grown even further. However, there are many more opportunities within personal and commercial. We see UBI only increasing in use as insurance companies decide to leverage the data collected from various devices and consumers begin to see hyper-personalization and value in a pay-as-you-go model. Eventually, your rates will be automatically changing based on how many times you went to the gym and which route you take home from work. That is when we finally get back into the office. There will also be opportunities for insurance to be embedded in the gig economy, and soon you'll be buying insurance for your Airbnb stays and your Uber rides. The fundamentals of insurance and underwriting have always relied on data, including the complex statistics that inform decision-making behind determining premiums. Now, the collection of data has become easier, faster, and more accurate with each connected device. Since data privacy is always in question, insurers are also getting creative. As one example, through its DriveWise program, Allstate provides a discount for drivers who install monitoring devices in their cars. And John Hancock provides discounts for individuals who provide fitness data through Apple Watch or Fitbit. Obviously, the more data we feed into our models, the smarter they get, and the better conclusions they provide for insurers, which ultimately means a better rate for you. We're seeing more and more use cases for AI in insurance, including for pricing policies, recognizing risk or fraud, and even for operational efficiency. One of our portfolio companies, Daisy Intelligence, leverages AI for a number of modules in the insurance space. DAISY ingests and ensures critical data and uses optimal control as a reinforcement learning technique to identify anomalies in the system. This means that it doesn't require known bads to train predictive models for finding fraud. Or in simpler terms, the technology is able to spot outliers just like a human would based on certain data points. DAISY shows the range of fraud affecting profitability, from low volume, high value, complex scenarios to high volume, low value, abusive behaviors. And this means that insurers can quickly detect and efficiently investigate fraudulent activity, which can save them millions of dollars in claims payments. There are so many examples of how AI is being leveraged in insurance. The tech market map shown on the right is certainly just a snapshot of many, many players in the insurtech space. What's clear from COVID is that, like every other sector, it has highlighted the value of data to the insurance industry. Data sets on rates of infection, legislation on closures, or mobility for contract tracing can all be incredibly valuable for insurers to assess risk. Like a lot of other industries, the insurance sector will end this year much differently than how it started.
Thanks, Shambhavi. So our fourth prediction is on infrastructure. Now, there's a lot we could talk about on this topic, including payments infrastructure, but here in particular, we chose to focus on the move to the cloud. Now, as a result of COVID, we think that the implementation of cloud as a business strategy will enable large financial incumbents to truly embrace digital. And we believe that this pandemic has acted as more of a nudge to help expedite this transition to the cloud across many sectors, but in particular in banking. It's interesting, the Department of Homeland Security includes financial institutions as one of 16 critical infrastructure sectors that, if they were destroyed, would have a debilitating effect on security. Well, fortunately for us, a pandemic is not nearly enough to destroy banking technology infrastructure, but the drastic changes to working conditions, including the needs to work from home, along with record-breaking levels of volatility, have definitely challenged the status quo. In fact, in March, when volatility surged, volumes on the NASDAQ reached 60 billion messages a day, which is more than twice any previous record. And in a digital environment, banking infrastructure obviously has to remain stable for things like payments and securities. But what's impressive is that as of the end of March, there were actually no major outages of core infrastructure reported, despite these really high levels of volatility. Now, pre-pandemic, it was estimated that only a quarter of the activities of the largest global banks were cloud-based. However, in the last few months, cost savings are a big reason for the increased migration to the cloud. Other reasons include the need to work from home and more of these trends to digital banking. But this also allows institutions to compete further with the small and agile fintech players. Even though banks have powerful data and resources, sometimes they're unable to leverage this just due to the complexity of the org structure or how data may be stored across legacy systems in the firm. And additionally, it becomes even harder to run these complex algorithms or leverage AI or ML. Now, historically, there have been concerns regarding security and compliance on the cloud when compared to on-prem. And so most areas that have moved are the high compute areas like risk management modeling, whereas personal or sensitive data and trading have not migrated. But in the past 2 years or so, although it's not perfect yet, the tech giants have engaged more with regulators to improve this. Container technology means companies can use multiple cloud providers as backup, switching between them in case of problems, and cybersecurities that are backed by these well-funded tech giants have also improved. And we're starting to see these shifts now. As one example, in July, we saw AWS and HSBC sign a long-term strategic cloud agreement, starting with consumer-facing applications and global wealth and personal banking. And once again, coronavirus has expedited this shift, and we think it's the final push for many banks. So our fifth prediction for the change in financial services is around capital markets. And we think that traditional methods of price discovery will no longer be relevant, while retail trading will forever be digitized. Okay, so what are we talking about here? So let's just have a Webster's dictionary moment for a second. So at its simplest form, capital markets help to facilitate growth by providing the intermediation of capital between those who have it and those who require it. So how are capital markets changing from this pandemic? Well, and perhaps the most obvious example of the impacts of capital markets has been through the extreme volatility that we've experienced. And this volatility was combined with an increase and often urgent need for capital. We can all remember this during the onset of COVID, as shown by the VIX in the above photo, which hit the highest level since 2008. And the institutions behind these capital markets had to provide the funding and liquidity required to maintain the economic stability, all while a lot of them were challenged to work from home. But the banks responded incredibly well and have proven to be very resilient. As one example, Royal Bank was able to have 95% of its traders work from home during the peak of lockdowns. And this is a really incredible feat considering there's over 7,000 employees in capital markets and 70 offices in 15 countries. Now, as we head back, hopefully, into more of a new normal, with some employees now going back to work, it might be less obvious on how the business of capital markets might change. But this is where our view on price discovery kicks in. And volatility and this deteriorating credit quality that we've seen have made this really difficult. As an example, by early March, as companies were facing massive shocks to their business models, over 150 companies warned of earnings misses for Q1, and they had more concerns heading into Q2. But instead, by Q2, the data reported that 84% of S&P companies reported a positive EPS surprise, and 65% reported a positive revenue surprise. The second quarter was actually the highest percentage of S&P companies reporting a positive EPS surprise since FactSet began tracking this metric in 2008. And so far, Q3 has been trending similarly. And so what this means is that predictability is really, really hard. And it's no surprise that the sudden and dramatic impacts across pretty much every sector have made predictability and then ultimately price discovery really challenging. Now, obviously, this same level of volatility has not continued since the onset of COVID, but the way the market reacts to these types of black swan events can be really interesting to observe. In fact, the markets didn't even price in much of the COVID-19 situation, even as it began in China. Studies have shown that in most cases, returns were actually uncorrelated with changes in the number of deaths after accounting for the number of new cases. And so this is why, in the absence of reliable fundamental data, we think that alternative data has the potential to play more of a role in determining prices. And traditionally, hedge funds are known to use this data to attempt to provide unique or timely insights about a company. One of the earliest examples of this is actually from a Toronto-based company called Quandl, acquired by the NASDAQ in 2018, is a simple relationship that if an individual is going to buy a car, then you'll also buy insurance. So by combining the number of new policies from insurance providers, Quandl could start to extrapolate an accurate estimate of new car sales, potentially ahead of other published data. And COVID-19 has led to a boom in alternative data after many investors found that the official numbers were just too slow to reflect what was actually changing in the economy. As an example, investors use alternative data to measure the movement of Chinese container ships to monitor activity or economic growth. They could compare social media posts in China with the Chinese government statements to gauge the extent of the virus's impact as well. In fact, even when the pandemic shook the labor markets earlier this year, the US Federal Reserve itself built a new gauge based on daily employment data from Homebase, which is a scheduling and time tracking tool used by 60,000 businesses. And this created a real-time indicator of US employment, which actually aligned very well with the official reports that they followed later. And the spend on alternative data is now expected to exceed 1.7 billion, up from just 400 million 3 years ago. And as you can see on the slide, there are now over 1,500 providers of this type of data. But while alternative data can be useful when fundamentals are in flux, the challenge is that most data is either just not clean or it's not useful for a lot of investors. But we would argue that this pandemic has highlighted the clear opportunities beyond just the fundamentals. And the one new trend that has certainly been confirmed is that individuals are much more comfortable with online and mobile trading through COVID-19. Robinhood added 3 million funded accounts the first 4 months of the year and is reportedly close to 13 million total as of October data. And for some context, Robinhood announced it would offer zero commission trading in 2013, and other publicly traded firms like Charles Schwab, E-Trade, and TD Ameritrade, and you can see some on the slide, a lot followed suit by 2019. And these peers have all experienced record level account growth as retail trading has surged with the overall equity market. And you can see on the chart how Robinhood's payment for order flow revenue, which is the amount that it earns for routing orders to larger trading firms, doubled from 91 million in Q1 to almost 180 million of Q2 this year. In fact, one of my favorite columnists, his name is Matt Levine from Bloomberg, and he called this the boredom markets hypothesis, which says that ordinary people will trade more if, one, trading is entertaining, and two, if other activities are less entertaining. It's pretty simple. Basically, the more bored people are, the more they trade. And during the initial lockdown, people were obviously bored and attracted to the market volatility. But in addition to his theory, we would also argue that a huge reason for this growth is also the easy-to-use digital trading platforms and the comfort of using devices to trade. So even while volatility has calmed, we think that for most consumers, the comfort level of trading at home through a device will likely remain. And once again, I mean, this was a fundamental shift that wouldn't have occurred at the pace it did if not for the coronavirus. So our sixth prediction is on money movement, and COVID-19 has even altered how we move money, and how we think we will move money will fundamentally change. And I'll refer back to Peter to let us go through this in more detail.
Thanks, Amy. One of the big things that we've been pondering is money movement, how we actually get money from one currency to another, from one place to another, either inside of national borders or outside in between countries. And Forbes estimates that in 4 years, the digital growth of money has been compressed into 2 months. What's fascinating about this for me is that as we think about the future of money and we think about currencies and the digitization of currencies, we obviously start to look at cryptocurrencies and their way and example of allowing people to move money from one geo to another, basically friction-free. As we go forward, we think the peer-to-peer money movement market is going to continue to explode. So the Bank of Canada is well aware of this, and they've started to really put some effort and research into what the future holds. So with COVID, they think that these surge in online activities will mean that a digital central bank product is likely necessary a lot sooner than they thought. Last time we had a chance to speak with anyone from the Bank of Canada, they were thinking somewhere in the neighborhood of 5 to 15 years. I would suggest to you that we're talking about a 1 to 2 year time frame before central banks around the world start to digitize their currencies. This has a profound potential impact on money movement, on inflation, and general macroeconomic trends. We are really starting to enter into uncharted territory here, and the ability to move slowly is starting to be taken away from us.
Perfect. Thanks, Peter. So that brings us to our final prediction on retail banking. And we think that from advice to simple banking, the role of the branch has entered a new age of omni-channel delivery. And we predict that the retail banking experience will be digital first, with the branch as a secondary channel. And eventually, there may be no need for a branch at all. So while concepts like neobanks that operate through fully digital channels have existed for a few years, most of the challenges around these traditionally are that some could be less regulated than traditional banks, or they might just have a harder time building the initial level of trust that a lot of consumers need. And now, obviously, these models, a lot of them have done really well during COVID-19. And the big difference now is that all consumers have been essentially forced to move digitally during COVID, at least during a certain part of this pandemic. And we've seen a change in consumer mentality that we've never seen before. And as you can see from the stats that we posted above, this is pretty similar across the board. I think in particular, Plaid found that 80% of consumers said that they can bank without a branch, and that's obviously quite significant. Now, in most countries, bank branches have felt the impacts of COVID. At one point, KPMG reports that up to almost 25% of bank branches had temporarily closed, and the remaining 75% were operating on reduced hours with reduced staff. So a lot of people just didn't have any access to branches at all. I know personally, I had this issue back in April. I was trying to open a new account and I just couldn't physically go in. I needed to print some documents and I don't even own a printer at home. So unfortunately, this just didn't happen for me at the time. And I don't think I'm alone in some of these issues. And this has forced banks to reconsider their digital financial services to an immediate need, and it required an evolution of a lot of these processes for things like electronic documents and signatures. One of I think is a really impressive data point is from Bank of Montreal, and they found that the weekly rate of customers signing up for digital banking jumped up 300% in April. And interestingly, this adoption is happening across age groups. Another favorite stat of mine is from CIBC, and CIBC found that Canadian seniors over the age of 65 experienced a 250% increase in digital banking in the same month of April. I mean, this is massive growth. And since the initial temporary closure of a lot of branches, services continued to grow online. Obviously, without as many in-person appointments or walk-ins, banks have needed to leverage new digital channels to help cross-sell products. As one example, online mortgages have grown. So after pausing in the spring, there's been a lot of recent activity in the housing market, which has led to an increase in online mortgages. As one example, Rate Hub experienced a 62% increase in users year over year for its mortgage products. And online deposits are also growing. Equitable Bank took almost 2 years to grow from 2 billion to 3 billion in deposits, but in the last 3 months, the platform grew to over 4 billion. And EQ estimates that 60% of this growth was due to COVID-19 as Canadians rushed to add to their savings, or they were able to allocate more time to research where to save. But what's clear to us is that across all financial products, COVID has expedited this need to move to online channels. And again, you can see some of the stats above that we've pulled from JD Power's survey back in April. And like most expedited trends for financial services, prior to COVID, banks were already reducing the sizes of their branch networks as they're typically costly to open and to maintain. And as you can see, the FDIC estimates that US bank branches had been closing at the rate of more than 3 a day for the last 10 years. And we're starting to see more of a shift in Europe. Deutsche Bank recently announced its plans to shutter 1 in 5 branches in Germany. It was looking to save costs and capitalize on what they're calling the changing habits of consumers during the pandemic. And similarly, Commerce Bank announced it would be closing 200 of its 1,000 branches due to an increase in online banking. And Commerce Bank cited that they were seeing more complex advisory services taking place through the phone or video chat, and that they were going to invest more into these areas. Most recently in New York City, 100 branches have closed or are set to close across the city, which is actually the largest level of retreat in more than 2 decades. And I could probably keep going. But we will acknowledge that the challenge behind the concept of fully eliminating bank branches really lies in the amount of unbanked consumers. And this challenge isn't new. 25% of all US households are in the underbanked or unbanked category. So this means that individuals don't have a bank account, or they have an account and they might use financial services outside of the banking system like payday loans. And in most cases, this group does not have enough money to keep an account. Some might choose not to, or others just don't have access to branches in certain physical locations. And this challenge was highlighted further when those without a bank account even struggled to cash their stimulus checks without incurring really high fees to do so. And there's no simple solutions to many of these issues, but the growth of fintech providers, both from the legacy payment companies into the startup world, have certainly helped to democratize these financial services to help improve accessibility and lower the barriers to access. Just as one example, conversational AI is one way to help ensure that customer service is more available if there's no branch. And as one other example, China's Ant Financial actually addresses this challenge really well. They're focused on building financial inclusion in China, where millions have traditionally been outside of the formal banking system, and they do this through a number of ways. Now, despite the needs for digitization, there are also plenty of opportunities for improvement. JD Power's survey found that only 52% said that their bank was really effective at meeting their online or mobile banking needs. And as you can see above, there's definitely opportunity to increase adoption of both online and mobile banking across different product lines. As banks have enormous access to data, we think that personalization still remains really crucial to offer individualized experience, and this will help the user feel that they're still getting that in-person service. And while our thesis is that every financial service can be connected digitally by the end of 2021, like most technologies, the humanized aspect of any digital experience has to be included. And again, we predict that these trends to omnichannel banking will continue in the years to come. So the future of money is happening now in 2020. And as we just touched on, there's 7 areas that we've identified expedited levels of change. There are definitely others, but for us, this is what we thought was most relevant. And we expect that every financial service and product to be digitized and to be informed by the data around us. Large traditional banks are making a lot of changes in their underlying business structures to take part in this. And we're seeing a lot of this now. And for us at Framework, this goes hand in hand with our data-driven thesis, and it also complements the way that we believe that technology will shape the future. Both businesses and consumers will continue to interact with financial services differently, and we think that this data will be used to inform decision-making for things like credit, insurance decisions, and even more that we touched on. And for a number of years, financial institutions and consumers have been on the brink of accepting a lot of these changes, but as we've seen, the current pandemic has really expedited this need. And most importantly, we think that the startup community will continue to offer and enable these solutions needed by consumers and the financial providers. While it's been a challenging time for us all, we continue to be amazed at what this community has developed and what we see every day. And we look forward to what the ecosystem creates next and how we can support these world-class companies. And I want to thank everyone for attending this morning. We really appreciate it. And I think we still have a little bit of time for Q&A if there is any.
Yeah, Amy, why don't I do a quick little introduction on how we're going to do Q&A. So on your Zoom link, you will see an ability to type in a question. And what we'll do is I will read those questions out just to make sure that we can screen them and make sure they're appropriate. But before we go through the questions, What I thought I would do is I thought I'd give some high-level critical takeaways from our database, from what Framework has been seeing in our interactions with, as we said, well north of 1,000 fintechs. Some of the critical takeaways is our continued belief that the future of financial services will largely be embedded in applications that people use every day. The idea that people and businesses want to go elsewhere to be able to perform simple banking tasks, we think is starting to compress. We believe that complex financial decisions will always require a lot of research and attention, but that the model of traditionally expecting people to do all of their banking inside either a banking application or a branch is probably coming to an end. We wanted to highlight that a couple of banks have really embraced this in a big way. RBC's model to embrace new engagement is really having a profound impact on the market, as an example. Owner is now the largest fully digital company creation platform in Canada. And we think that that has a profound, very positive potential impact for RBC services as it relates to small businesses going forward. In terms of fully cloud-based core banking systems, which a lot of banks have said that they struggle to achieve, we are aware that EQ Bank has moved its entire core infrastructure to the cloud. What that enables is faster development cycles, more experimentation on user engagement, and the ability to innovate off of a very, very flexible platform. The last point I'll make from our research is on the branch side. So reimagining what a branch can and should be is kind of a fascinating area. But one branch that we think is quite innovative, and we've seen some really good engagement with, is Capital One. They've turned a lot of their branches into effectively coffee shops where you're able to, as you would in a Starbucks, engage with some great espresso and caffeine and perform your banking. So we think these critical takeaways continue to reinforce our FinTech 2.0 thesis. With that, I'll start reading out some questions here to Amy and the team. Assuming that a Canadian and a US and UK, Chinese, etc., CBDC arrive within 2 years, it has the potential to eliminate need for deposits at retail banks as a CBDC on the deposit with a central bank. And what he's talking about here is a digital currency. Is that not actually a pending black swan for retail banks that most inventors in financial services haven't realized yet? Or do we think that the vast majority of people employed in financial services and other issues will cause regulators to behave differently? Any thoughts on that, Amy?
Yeah, that's a lot in that. That's interesting. We didn't talk a lot about any crypto coming in the short term and really overhauling the entire system. I don't think we're going to see that. As we've seen, these trends have been expedited, but things still take a little while to play out. And of course, regulation will play a huge factor in that. And depending how quick that timeline is, that's a question I don't have the answer to that one. But we've seen that's been the traditional pullback or pushback really with any crypto that's overhauling any type of system. We saw that with Facebook's Libra most recently.
Yeah, one thing I will add is that the reason why central banks are moving into this area gingerly is that it has a profound impact on the macroeconomy. Money and money movements internationally potentially can transmit both inflation and deflation. And unless you have a closed economy or closed ecosystem, the introduction of digital currency actually has profound impacts on how and where and when you transmit those inflationary, deflationary pressures. Being able to understand that, predict that, model that is the role of a central bank. And taking those roles away, again, could have a profound and potentially negative impact on the economy. So they're going to proceed gingerly. They are going to tend to be a lot of models that they're going to work through before they launch this. So the next question is, what do you believe the uptake from retailers will be in 2021 to accept QR codes and different forms of payments? So I'll answer this one. I think QR codes are going to start to see double-digit adoption. We're starting to see some POS companies really focus on contactless. I also believe that you're going to see not only QR codes which rely on cameras, but audio QR codes, whether it's Listener and Visa or SoundPay's and its partners. We think effectively audio QR codes are also going to be in the market, and we expect at least 10% of retailers will accept that form of payment in 2021.
I can just add on to that, Peter, we've seen, there were quite a few really interesting examples of QR integrations that I came across when we were doing this research. One, I saw that Crate and Barrel is rolling out QR codes, Uber Eats, and even a football team, the Jacksonville Jaguars, I believe, has added QR even through their concession stands. And so just to add on to Peter, I mean, we do see that adoption growing, but you're seeing it happening now.
We have a question here in terms of fundraising for early startups. What do you think will be the digital trend going forward? They're asking probably here for a macro overall trend that we're seeing in startups. Amy, I'll let you start there.
Sure, I'd say overall, and the data continues to come in for Q3, but on the fundraising side, we saw through the earlier half of 2020 a higher portion of dollars going to later stage companies, and that was just reflective of what was happening in the market and a lot of uncertainty at the time. We do see that eventually pushing back. There's an increase on the angel side as well. That's just generically happening with what's happening in the market. But we do, I mean, we are positive that that will continue to evolve as we see a lot of opportunities. On our side, we've been incredibly busy, that Peter can speak to further, of course, but we see a ton of opportunity at the Series A level as well.
Yeah, just to give people a sense, this has probably been the busiest year of a nearly 20-year venture capital career that I've ever seen. Right now, our data team is engaging with roughly 10 to 20 startups every day, and approximately 400 to 500 startups come into Framework every single month. Of those, between 30 and 40 are in the Series A category. I can't tell you how profoundly busy that makes our team. But I would say on a high level, what we're seeing is that companies are really focused on engagement. So I would give you the digital trend is that people are focused on an engaged audience. And we think that that's an important digital trend. Building something without having market feedback or market input is something that I think is extremely difficult to fund and extremely difficult to scale. Having that market input is really the biggest digital trend that I would suggest to folks out there. Next question here, a few, if any, predictions come 100% true. Which of yours do you think are the most risk of not coming true if consumers revert back to some of their behaviors pre-COVID? Amy?
Good question. I would say of all of them, I can even flip back if we want. I would say the biggest risk of not coming true for me, at least, is the retail banking side. The reason I say that is I think about online shopping and how that's grown substantially, obviously, as we've seen, but there's still the desire to go back into the store and get that in-store experience. And so I do relate that in terms of banking as well. Some things, as Peter alluded to, are just more complicated transactions, and people will have a little bit of a harder time doing those through a mobile device, for example, or through online banking. And so I think of all of them, that's where I see the potential for at least a delay in that rollout. But that's why part of our white paper, we talk about how it will be a secondary channel, at least for a while.
Yeah, the only thing I will add is that human beings crave interaction as a majority. And that interaction, that craving for interaction is probably going to have some pent up expectations here, especially as the Northern Hemisphere goes through a pretty long winter. So that could be something, the evolution of the bank branch, and what I highlighted with Capital One may actually result in bank branches not closing down at the rate or the sheer number that we thought, and becoming more of a meeting place, more of a hub. But we feel pretty confident in saying that the branch of today is unlikely to be the branch of tomorrow. Next question, with the rapid acceleration of change along the 7 trend areas, what is the biggest structural or regulatory bottleneck that will slow it down?
Good question. I naturally come back to on the money movement side and any implementation of an overall cryptocurrency, anything on that side, I can see being most affected by that. Peter, is there anything else that you would highlight?
Yeah, so I think money movement, and I'm going to explain a little bit more detail here why this is so dangerous and why regulators are going to try and be as cautious as possible, even as the future starts sort of rushing towards them. As you move into a digital currency, again, the ability to transmit implications into an economy and the ability to manage and model those become profound and extremely difficult. There are a lot of people that are proponents of new economic theories out there. And the reality is we just don't know how quickly or in what degree that those impacts will transmit into an economy. The problem is that we don't have a small economy that we can showcase what that we learned or didn't learn. This is truly white space and we don't know. The other thing I would say about money movement and payments in general, one of the reasons why instantaneous money movement or payment risk reconciliation is difficult is really through fraud and nefarious activities. The idea that a human being, and I've been a victim of my identity being hacked in Canada, that someone could come in, take over your bank account and move all your money out or get a mortgage and put on your place very quickly is extremely troubling. And the safeguards for that, especially in a Canadian context as it relates to Ontario more specifically, is quite troubling. And what's happening is that the government agencies, while they have good intentions, and a lot of the departments have good intentions, we're just not moving fast enough to secure our personal information and to enable fraudsters to have a more difficult time. Rather, our systems and processes today actually are very fraudster friendly. And so we really need our governments at all levels to understand what the future holds and to put laws in place that allow human beings and people of any nation to have confidence and trust in the system. Next question here, what are some of the newer avenues that the Canadian commercial grade businesses, so think of annual revenue 5 to 100 million, will be looking to get access to debt and equity capital? How can traditional banks adjust their in-person and digital practice to mirror these new opportunities? Basically, what's the future of lending in scaled Canadian companies?
Good question. And so just on that, I mean, what we've seen through COVID is a need to address the SMB to mid-market debt markets quickly. And that happened. They're a huge part of the economy. And we've seen a lot of startups that offer, automated underwriting that can use things like machine learning to deliver this on a more scalable level. So they can simultaneously review a bunch of data points, which is sort of what we were alluding to earlier on, where when we think about how lending will look, it will need to integrate these types of data. And so I do think going forward, I mean, we'll see this more and more in Canada. I'm sure banks are working on this as well. And we've seen it through the fintech market and a lot of companies that we observe that are addressing this very market and trying to increase the level of loans for this market that is so necessary and has really felt the brunt of a lot of the economic pullback.
Next question, while the mortgage processes are being digitized, are there parts of the process still broken in your view?
Good question. Peter, you'd probably be better equipped to answer this than me, since I haven't actually gone through the mortgage process myself, but am looking at it. And that was part of the challenge that I actually faced back in April, was thinking about how to do this from a virtual setting. So Peter, I'm not sure if there's anything that you'd be more willing to discuss here.
Yeah, I think there's a handful of aspects here. The first is that the sheer amount of paperwork, that the paperwork, it really hasn't been rethought. It has basically taken all of the physical paper forms and we've digitized them. And while that's helpful and that removes some friction, it really doesn't address the reality of what the new norms are. And not sure that it provides all of the support and asset claim capability that the lenders would love to have. Appraisals are currently a huge issue. During COVID, home prices in certain geographies have absolutely accelerated. And in other geographies, they've literally fallen quite dramatically. And so the ability for lenders to have more real-time data as it relates to appraisals is a key critical area. I would just step back and say, what a mortgage really is a lender's desire to give you capital that is secured against a very valuable asset that has endured and held the value over time. Rethinking that whole process from start to finish, what the actual objective is and what friction points are throughout the process, is probably something that we would love to see. I know a lot of banks are spending a bunch of time doing this. And I go back to RBC Ventures, where they're trying to really rethink the entire process, not only on what it is today, but how it is in the future. And we would encourage all banks to think that way. It is really a model, we think, that is super important, in that consumers and businesses, that's their expectation. They're expecting their banking provider, their financial services provider, to mirror a lot of the experiences they have in their everyday life. I will say specifically that some of the younger people that we work with on the team, they've never been in a bank branch, and the process of opening a bank account or getting a credit card or a loan, some of these things, just when they see that process and they come back and they discuss it with you and they walk you through what they thought was going to happen, what happened, it really does need a reimagining. But overall, I think the Canadian banks in particular are in great shape. A bunch of the big US banks are making some significant moves. And we think the market is extremely dynamic. We are going to see a lot of change, and we're excited for that. So with that, there's no further questions. I want to thank Amy and the team for all of their hard work. The white paper will be available on our website. Please feel free to reach out and to download it. It's available at framework.vc. As a reminder, we do this for the ecosystem, and we do this for the benefit of the ecosystem. We would ask that everyone that participates in this ecosystem come from the right place, which is, let's find a way to continue to move ourselves in a positive direction that meets the needs of the ultimate end user. And working together, I think we can continue to build what I hope will be a much better, smoother, less nefarious ecosystem. Thanks so much.
Thanks, everyone.